Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carillo.
Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have David Thompson. David spent over 20 years in high-tech management positions at Dell, AT&T, and managed a $2.5 billion investment portfolio at Lucent Technologies while also raising $1 billion for acquisitions. Just over 3 years ago, David left the corporate world and started Thompson Investing, which offers the investors the opportunity to invest in apartment communities, mobile home parks, and self-storage complexes. David recently has surpassed $110 million in investor capital invested in 30-plus syndication deals, and once raised $4 million in 48 hours, which is a story all to its own, I would imagine. But thanks so much for being on the show today, David.
Charles, thanks for having me. I appreciate it. Yeah, good to be here.
Yeah, it's great to have someone with your expertise in investing in so many different asset classes, because normally you'll get someone that specializes in just one of them. And I briefly touched on your professional background, but can you explain a little bit more previous to your corporate career before you launched?
Sure. Right. I mean, out of graduate school, I went into the corporate world and worked in a variety of management roles in high tech, and landed across the country from Los Angeles, New Jersey, North Carolina. Came back down here in '97 in Austin, and it felt real comfortable, like an old shoe. I liked the environment, the weather, and things. I was from Phoenix, so I enjoyed being back south, and raised a family here. We got here in '97, so up to about 2015, and worked for Dell down here as my last job. And then as the kids got a little older, one went just recently graduated from UT, and one's a senior in high school. They were a lot more independent, didn't need me as much, and I was getting a little bit restless. I had invested in some single family homes here in Austin. It ended up being a really good market here, and was starting to do some research on how I could leave the corporate job. How do I do that with passive income? And syndication just was a way to accelerate that path. And the problem with single family and maybe some small multifamily under 4 units is that you have to have a W-2. And that was something I was trying to move away from after having a fun career, but ready to try something different, entrepreneurial role. And like a lot of people, got bit by the bug of the passive investment mantra and managing your own destiny. And so I just kind of got into that and got with the right people, amped it up, and we can talk a little bit more about that ride as we go on.
Nice. Now, your firm focuses on a few different asset classes that I touched on: the mobile homes, apartments, and self-storage complexes. What is unique between one to the other in the sense of when we're talking with returns versus risk?
That's a great question. I like all three from a standpoint of if history would show that all three of those niches, and the reason why we're in them is because later in a cycle especially they do well. They do well in downturns. They tend to hold up very well. And specifically, I would say value add approaches, which is where we're actually going and buying older properties that aren't as expensive typically than a brand new with property. So you're getting a little bit of a buffer there, and then you have an opportunity to renovate and streamline operations to increase value. So I like the niches because there's an opportunity to do something with the property. They tend to hold up well in downturns. Apartments and mobile home parks, people have to live somewhere. Self-storage, we buy a lot of stuff in up markets. We tend not to get rid of stuff. We're kind of a nation of hoarders. And we forget about stuff in storage, like a gym locker. You may have it for 3 years and you forget, maybe this $100 payment is starting to bother me, or why do I have this stuff? But after 3 years, we made our money, right? So that's good. But if you look at the history of performance, Charles, over the last 25 years, and this is coming from the National Association of Real Estate, REITs publish this data every year. Apartment self-storage and mobile home communities have 2x'd the S&P 500 in returns. And I would say a large reason why that is if you look at the years between 2007 and 2009, the stock market was down 22%. Manufactured home parks actually did not lose money. They were up like 0.5%. Self-storage only lost 3.5%, apartments 6%. So if you look at the data, it's like, wow, over 25 years, they've outperformed the stock market and they're less volatile. So that caught my attention a few years back, and hence I make this as kind of my core focus for my investments and also my investors. Yeah.
So even with self-storage, it's that recession resistant, huh? I mean, only went down just a few percent. I mean, I imagine if it's being billed to your credit card every month and it's $50, it's probably not, or whatever, $50, $100, it's probably not a huge issue for someone compared to other parts of the economy that rely on, like cars, where it's going to be, it's not a $50 car payment. So.
That's right. I think that's a key point you make. I think the fact that, if you thought that we raised the rents and it started to be, like, say it's 95 and it goes to 100, and you keep doing that for 2 or 3 years, and it's kind of out of sight, out of mind, that's that gym membership payment you kind of forget about. But then you maybe wake up one day and say, after a year or two, you're like, it's kind of going up a little bit more than I'd like, or maybe it's starting to bother me, but do you really want to go rent a truck on your weekend and go try to move it and try to save $5 a month somewhere else? Most people just say, heck with it. I don't do that. So even though you can competitive shop, it's kind of a sticky asset. Yeah.
The other thing I've heard from other operators before is just they go in and they figure out if they're going to build or not. And it's like they take the population, I think it's like 8 square feet of storage per person.
7, yeah. Okay. 7. And that's what I like about that space. It's got a very objective way of determining supply and demand. They go 1, 3, and 5 miles. It's called a feasibility study. The biggest downside to self-storage is oversupply. So if you get in a situation where you're in an investment and then a competitor puts a store across the street, it's not like it's going to kill the deal, but you may be, the first couple of years may be a little lean for you, right? And then as the demand eventually catches up. But that's what I like about it. There's some objective data out there.
Yeah, that's awesome. The now, as you focus by, or you specialize by niche, and then also by geography, and then you partner with a number of several different operators as well. So when an investor works with you, you can spread them over all 3 different ways of kind of spreading out their money.
Right. That's a benefit. I have a degree in financial planning, so I always had this hat on at Diversification. And when I first got in the business, one of my goals with investors or with myself was, listen, I'm going to work with an experienced partner, right? This is not going to be Dave Thompson raising capital and talking to investors and going to find his own deals and, hoping something's working. I'm like, my advice to people today is, go find someone that's doing what you want to be doing and, work for free, whatever you got to do, learn. So I just started doing that, and I worked, and I got to a point where all the deals were in Dallas. They were all apartments. And I liked them, but I was like, my investors would keep coming back and say, what else you got? And I was like, well, then I started my research, Charles. I'm like, well, I like self-storage, I like mobile home parks. And so I started finding other partners that also had a lot of experience in those niches. And, I co-sponsor with them on the GP side. I get involved pretty detailed in some of their, the vetting process and their underwriting and everything, and make suggestions. And then at the end of the day, I'm bringing my investors and their capital to the deal. And then I monitor that. But what I think our investors love is that we're kind of a one-stop shop. You don't have to go directly to all these different operators and have all these different experiences. We can kind of work directly with you, and we're part of the operating team, and we have these different opportunities to share with you and help you diversify along different operators and different geographies and different niches is really what our mantra is. Yeah.
Now, you must get so many opportunities that come over your desk that how do you utilize and choose opportunities to bring to your investor base? So is it you do your own stress testing? I imagine you do your own final underwriting with your team?
Yeah. On my website, this actually came out of a meetup group. One person asked me one time, well, this is great, but how do you vet sponsors? I'm like, that's a great blog. I'll go write a blog on that. And it ended up being a special report with like 10 tips on what I do when I vet a sponsor. It's everything from reviewing track records to, researching everything that they've done on Google on these people, because it's mostly an high integrity trust business. So I want to know who I'm dealing with. I will tell you, I don't do any transactional deals. So the partners I work with today were carefully selected. They were peer reviewed. And I walk every deal with them, and I don't have to do the deals with them. So I still have that vetting process that my investors appreciate. But at the end of the day, I'm selecting long-term partners. They tend to not change their criteria. They tend to focus on the same markets. I like their singularity of focus. I'll give you one story that would turn me off. So I was interested in this multifamily operator out of they were in Dallas based, but they were focused on Charlotte and Southeast, and there was a geographic area I didn't have a lot of coverage on. They'd done a few exits. They were kind of in this trajectory period where I could get a lot of their attention. I drove up there, 3 hours drive from Austin. We spent a nice lunch together. I said, this could really work. On the way back, they send me a note the next day and say, hey, Dave, what do you think about hotels? And then 2 weeks later, I got a hotel deal in San Antonio. I'm like, different geography, different niche. And I'm like, it just totally turned me off. So, to my investors and stuff, I'm like, I'm very careful about what niche I go into. I mean, these were niches were carefully researched. I went into multifamily first, then self-storage, and I added mobile home parks. But I was blogging and I was communicating with my investors far in advance before we ever chose a partner and before we ever actually did our first deal. So the last thing my investors want to know is, Dave woke up one day with this idea, saw a deal, saw a guy or a person, and just got it, fell in love with it. Now, for my personal investments, I may take a few, I don't want to call them flyers. I may take a very calculated investment in a small amount with an operator on a deal in a niche just to learn about it, because I don't learn anything unless I'm involved with it, but in a small scale. And that would be a good way, I think, for investors too, to test something out. Be prudent. If you're really, you've got to feel pretty comfortable, but don't go in big with somebody until you get a chance to learn how they operate, how they communicate with you. Because I would say, Charles, as much as we talk about the success of a project, and how it's supposed to roll out, it's how people communicate with you, keep you involved.
It's very true. I was at a real estate conference a couple months back, and people are like, how many people here are on an email of a syndicator? Everybody raised their hand. How many people are in a deal where they, as an LP, where they wish they had better conversation, they had better communication, and so many people raise their hand. You know what I mean? And it's just amazing that this just the updates of how it is. And the other thing too, which is great about what you said about going in as like a limited partner or so and investing with them first, I guess is how you're explaining it. That's great, because then you have the reports. You know what a quarterly report looks like. You know what a monthly report looks like. Right. And then you can, whatever, if you want to block out the information, you can show it to your investors and say, this is how it is. And the other thing too is we co-sponsored a deal a couple months ago, and walking the deal, because if you're bringing investors, right? We were bringing investors, and you could say, hey, we walked every one of these units. We walked all the units. We know exactly what this is like. How they're explaining it is true, in our OM. And this is kind of what we see. And, you actually, it's not just, hey, I got some pictures and I saw it on Google Maps.
No, it's key. It really is key. And I make it a point to get to the property with the operator, and typically the property manager's there that may stay or may not, but you get the full story, review the competition. Who are the key competitors? You walk the submarket. That's key. The other thing I get asked a lot, do I invest in every deal? And absolutely. I mean, I can't imagine sharing a deal with somebody and not investing in it. I just can't imagine that. But, it doesn't have to be huge because we do so many deals. But just knowing that you're aligned with your investor is really critical. Yeah.
Well, right now there's a lot of that going on where they're not investing alongside, and the alignment of interest, and you have people just making money just on fees. Stuff's being refinanced and stuff's being sold. That's maybe not the best point, just so that it can generate fees for the general partners. Sure. So what would be the main thing if you were investing as an LP with them? Obviously the focus on a niche, or if you were talking to someone to invest as an LP, it'd be have a sponsor that focuses on a niche, have a sponsor that's you have an idea of kind of the communication and the reports. Are there any other big points of stuff that you would suggest them looking out for?
Well, I mean, I typically would like to see focus on a geography, a metro or two. I do have one successful operator, kind of, there could be in 5 or 6 markets, but they're an exception and they're institutional based and they've got the resources to do that. But a typical value syndicator that I work with, it's a small shop. They're niche oriented. They're really good at a certain market. The broker relationships are, those are built over time by closing big deals in the market those brokers are in, and they're going to get you more attention. So I'd like to see kind of a singular focus on niche. We talked a little bit about, pick a market or two or three that they get to be an expert in and get those broker relationships set up so they get to see deals. Some of them are off market. That's important if they can get a couple looks at that. I think I'd like to see a copy of their communication. So I would actually ask them, how do you, if you are communicating with your investors, show me past deals. Obviously, track records are good. A lot of people ask me, it's important if they've exited deals. Yeah, it is important, but I haven't shied away from doing deals with people who haven't exited yet. If they check the box in lots of different areas. I certainly want to be doing as much research as I can on their integrity. What are they doing outside of this business? A lot of them that I'm involved with are doing their own podcasts. They're really passionate about the space. They had some background in construction. They have background in relationships and building relationships. And so, you really kind of got to spend some time with those partners if you can. I know it's sometimes for a passive investor, it's hard. I may be putting $50,000 a deal. How do I get all this time with people? But they should allow you. You should be able to talk to the partner.
Yeah,
you should be able to talk directly to them. Now, I'm kind of that voice for my investors, and if someone really wants to talk to the lead principal, that's fine. Well, you could probably make that happen, but I just tell people to be realistic and but do your own research and you should get fast communications. You should get accurate communications. You should get nothing that should be wishy-washy. If you want to see the underwriting for a deal, you should be able to see the underwriting for the deal.
Yeah.
If you want to see a sensitivity analysis for a deal, you should be able to see it. There should be nothing that really they don't want to share with you. They may not share with you their financial model on the GP side, how they make their monid. That might be the only thing, but they should be able to talk to you. Hey, we're kind of compensated this way. It's in the PPM. We get some fees and that kind of thing. And I like to know their deal structure. What's the deal structure? 8% pref, 70-30 is typical. If you start seeing, things are outside of the norm, then why is that? Are you super experienced or are you just trying to, get as much as you can, right? But investing alongside, we talked about that. I want to make sure they're investing in a deal. Yeah.
Yeah. It's funny because I was speaking to someone that was a limited partner a couple weeks ago, and they were saying that, about 4 deals they'd looked at and they invested in only 2 of them, and the other 2 operators would not provide them with the underwriting, which I thought was crazy because like you said, you can leave off that tab with the general partner if the, partner splits and stuff like that. Sure. But you already know if it's 80-20 or 70-30, you can have an idea of like the major thing that really affects you. But really the 12 tab, the whole Excel, they don't even send it over, and it's kind of like, because you go through, and if I'm looking at it as a passive investor, I'm going to take away some of the rent increases, maybe just bring them down low, and kind of do my own worst case scenario stress test, and I can't do that with an OM that just has some beautiful pictures on it and stuff.
Yeah. And I think if you're a sponsor, that doesn't mean hey, green light, I show you everything. It's kind of like if you ask, right, I'm sensitizing that most investors are passive investors, and they're not like you and I who are really into everything about this niche or needing to see all the details. They expect me to do that. So they're coming to me that, hey, they're busy, they're entrepreneurs or doctors or attorneys, whatever is going on in their life. They have families. Like Dave, the reason I'm going syndication and passive investing, I kind of want the investment summary. I want to be able to understand the market, the deal, and some basics around it, what the expectations are. But I don't need to see all that. So you got to be careful. You don't want to overwhelm people and send them the whole kitchen sink. But you should be prepared to understand if you have a person who's a little bit more analytical or who expects that, to be able to provide that. Because I look at it as you're partnering with us, right? You're a partner. Now you're a limited partner. You're not sitting on the board of directors and making decisions and all that. Yeah. But you're a limited partner and you're a valuable partner. And I would tell you, Charles, 85% of my investors in every deal are return investors, or I get referrals from return investors. So we want you to be feel like you're part of this, and that's why I think monthly communications and certainly I think anything that you can do to make people feel like they're part of. We want to keep you involved in understanding what's going on. You don't have to worry about the residents or something breaking on the property, but if you want something more detailed, we should be there to provide that for you.
Yeah. It's funny when you say that because with busier people, and I found when dealing with higher net worth individuals, higher income people, they're vetting you and they're vetting your team, the GP team, more than they are instead of vetting more the deal itself. So they're making sure that the people handling the deal are on the up and up, and all that kind of stuff is checked, other than looking at, hey, this is 17% IRR versus 19 from something else I got in my email box. You know what I mean?
Yeah.
So
you're just dealing with a bunch of different personality types, and you can kind of sum up pretty quick. I usually kind of talk to people about kind of what their background is, and if they're telling me an engineer, I'm pretty expected to maybe share some more detailed information.
Right.
And some people coming from the marketing perspective, not to stereotype, but some people are just more about you and get a good feel for you. But I think in the general spectrum, it's you just kind of feel out the investor and be prepared to share at the level that they want to be communicated with, right?
Yeah. So you've raised over $110 million from investors for your 30 plus deals that you've been part of. And your company works a lot with foreign investors. And I know you've regularly have investors that come in. How does do the goals for a foreign investor that come through with Thompson Investing differ greatly from maybe a U.S. investor? Or is it very similar where it's asset preservation and return? Or
well, I mean, at a high level, I think they're looking for global diversification, right? At a high level, and they're looking for tier one countries that have good transparency of laws and protections for property rights. And it's interesting. My wife's Chinese, and we just naturally had a pretty significant Asian base. I think because of that, she's helped me in the business when we started. And she's from mainland China, and they've had a great real estate run over there, right? If you have even one property, you might be a millionaire if you just had one rental property. Especially if it's in a big city like Beijing or Shanghai. So, we typically get a lot of interest, and people have seen success and what real estate can do to them. And a lot of these countries are in stock markets that are very like emerging markets. They're very volatile. Mm-hmm. And so you get people coming over here. I don't know if it's reduced expectations, but they certainly understand that we're not going to, be having those types of appreciation increases in our properties, but, still very attractive. But they're coming over here for stability and transparency. And I think also to put capital outside of their particular country, just from a safety standpoint, access. A lot of them have children who are going to college here, Charles. Okay. And so it provides them a way to, the properties that we have, are income producing. And so they may have the money. Sometimes it's hard to get money here. If it's here, they want to invest it. And then they want that property to generate income for family members that might be here they can utilize, or for themselves in retirement. Some may want to retire here over when they're done with their careers in some other country. But we do allow foreign investment into syndication. There's nothing that says you can't do that. There are some specific rules, right? You have to have a U.S. bank account. We don't want to be distributing overseas. No. The U.S. tax authorities want to make sure that you are doing your taxes here locally. So we advise the syndication groups actually have to withhold. There's a withholding tax, and so we want to make sure our foreign investors are aware of that. We do encourage them to kind of look in and seek tax advice, and maybe setting up a U.S. LLC. If they're going to do a lot of investments with us, then set up a U.S. LLC, have the taxes all taken care of by a tax company here, and get that all taken care of for you. But there's just a lot of interest in the U.S. Yeah. Every data point I say that continues. That continues for the foreseeable future, I think.
Yeah. Normally, if we have investors that come in that are abroad, it's usually having the U.S. LLC is something that we've required. We've never had anybody do it in their own personal name.
Yes.
And then also, obviously, they're having the EIN number, all this kind of stuff. Mm-hmm. But having them with a CPA and having them with a lawyer, we put them together with them, and that are well versed with international investors and well versed with real estate.
It's very specialized, right? Very unique.
It's a very niche.
You wouldn't be going to your typical CPA or accountant to ask for advice on that. They might want to ask for a referral. Someone who does that.
It's not going to be going to H&R Block to do it.
Yeah, they might need to get an ITIN number, right? That kind of stuff. Yeah.
And with the CPAs, I guess they can fast track that, and so it's all having that, and then also they can speak to possibly to their CPA in their home country, which that's
important too to note, right? Because they might have some laws and issues on foreign investing outside of their country that they have to. We have that, right? What would you generate outside of the country?
They want to get paid on everything.
Right.
So, so for a foreign investor or for any kind of passive investor coming in, U.S. or foreign, what common mistakes do you see passive investors if you've spoken to them before and something happened with them? What are common mistakes you see that they've done? maybe with their first deal or a couple deals?
The common mistakes that when people come to me, well, I mean, I definitely see people over concentrated. Like, I was talking to the guy just before this call, and he's in 3 new development apartment deals in Austin. Now, Austin's a fantastic market, and he feels like he's going to do well. I'm not saying he's not doing well, and maybe he researches it and really knows those. But he's with one operator. He's doing 3 development deals all in Austin. That's pretty concentrated. He hasn't done anything else, any real estate outside. So we were talking to him this morning about, and I gave a presentation yesterday that he listened to down in Austin to a multifamily meetup group on a book that I have called Riches and Niches, which talks about why I like the 3 niches and some of the data that we were sharing earlier. So it was like a perfect lead in. He's like, I gave my book away for free, which is always a good thing to do. Give everything away for free. Maybe something sticks with somebody, but it really resonated well with him. And he said, I really feel like I love apartments, but I like storage now, and I've always been thinking about these things. So I think most people who get involved with the real estate, typically it's local. And it might be accidental landlord. It might be getting a rental property or 2. One thing is they're just not aware of the different things they could be doing, and they try to do it themselves. And I encourage people that you can still have an active gene in you. You can still do some flipping. You can still do some single family buy and holds in your local market. But when you start talking about different geographies, which you should be thinking about, because if your local economy sours, then you got some assets somewhere else where it's booming. And some different niches, but also having experts doing some of this, right? Because that's where I think syndication and either you go all into syndication or you still have some active gene, that's fine. But I think people feel like they have to do everything themselves, and that I think can get you in trouble unless you're an expert, and then you can get over concentrated because I'm only doing this because I know it. That's great, but is that a job? Like flipping houses is a job.
Yeah.
Okay, so you got to keep flipping to keep making money. What are you doing? You need to be thinking about spreading those assets and making money. And the best thing is just having someone else who's an expert that spends 24/7 thinking about that market, that niche, those relationships, how to make money, and just do some more thought around diversification. I think is the biggest mistake I see.
Yeah, diversification on the business model, which is great because on the development, and then they might go into, even if it's apartments again, even if it's still in Austin or somewhere else in Texas or in the Southeast or say, but it's also, you're going from construction and development. Now you have something that's already cash flowing. So day one, it's cash flowing before we even implement the business plan, before the value add even goes into effect. You have something, you're making money, you'll get paid in 3 months or monthly, quarterly, however you do it. What books do you recommend for inspiring active, passive investors and just learning more about cash flow in real estate?
Wow. So, I mean, there's everyone says Rich Dad, Poor Dad. That would be good. He's got one called Cash Flow Quadrant that I liked. And it's just anything that can expose you to, leverage and just, not trying to do everything yourself and how things can cash flow and is important. I'm kind of there was another, Gary Keller wrote a book, The Millionaire Investor. I think resonated with me, got me more thinking about syndication and not just more houses. It wasn't more houses. A lot of people start, going on just buying more houses, and you realize, wow, I could maybe buy an apartment and save the trouble of all the hassle there. So I think that was an exposure to scale. So that book really taught me about scale and started thinking about that. But then you can't forget the little things. I just got done reading this book, and I brought it over here because I wanted to make sure I had the guy's author's name on it right. And it was called Atomic Habits by James Clear. And it says easy and proven ways to build good habits and break bad ones. And, there's so many, if you look at success and if you analyze it, it's typically, what do I do every day? What am I doing every day to get me to where I need to go? There's goals, but breaking it down. But I really thought this was good because so many habits we don't think about. All of a sudden we're doing something and someone makes us aware of it. But it was a kind of a clear and concise book on how to maybe incrementally improve your life and get you going in the right direction. I mean, 3.5 years ago, if you would have told me we would have $110 million assets under management from what I'm doing, listen, I failed coming out of college in a sales and marketing role. I don't feel like I'm in a sales and marketing role. I may be marketing, but my marketing is subtle. It's thought leadership. It's what you're doing, Charles. You're providing really good free content to people. And that's what I started. My mentor was telling me start blogging. Now I'm doing a podcast interview. My biggest investor came from podcast interview. I was being interviewed.
Nice.
People want to see you as a real person. Are you genuine? I get that, you maybe don't know this finance stuff, but who are you as a person? I make it a point on my website. I got a family. I got, 2 daughters. I got a wife. I mean, I'm involved in the community. I've got things going on. This business is all about relationships and integrity. You should know that as much about me as the investment offerings I have, right? Because I think that says a lot about you as a person and what you're doing. So in your quest and pursuit, I learned so many things in a short period of time I want to tell you, but essentially just because you're not an expert now or just because you don't know what you don't know, keep an open book. Surround yourself around people who are experts in areas that you think you might like. I knew I liked syndication. I knew I liked investing in commercial real estate. That's it. Then I found a guy, Joe Fairless. Everybody knows Joe, right? I ran into Joe on Bigger Pockets, and I was looking at the right time in my life to find someone to help me understand apartments better. He had a small mentoring group. He was just starting it. He only had 2 apartments under his belt. I ended up taking that, asking him one day how I could help him. And he said, you can meet me at the property. I want you to understand the business plan. Help me look at this underwriting and stuff. But we need $8 million. Would you be interested in talking to some of your investors? Because, hey, if you start doing your own deals, which is what this mentoring was all about, you're going to need to have this investor network. He says, by the way, those investors you bring to our deal are your investors. I'm like, perfect. They're not our investors. You're part of our team. They're your investors. We won't talk to them. You talk to them. You educate them. And so that was magic to my ears. It wasn't like I was ever selling. And if I ever felt like I was selling something, I was doing it wrong. Listen, I have a good market. I have a good deal. I can explain it to you, and I can show you how to get in these deals. We'll monitor for you, and we expect to do well. And there it is. And if you have questions, I'll answer your questions. And if you come to a point where the questions are done, I'm like, great. Are you interested in moving forward? Yes or no. That's fine. If you're not, we'll put you on our mailing list for future opportunities when the liquidity is there. You're ready to do something. If you are, great. Let's help you get in. We'll monitor it. So it became a very logical discussion. And what blew me away was when I got out of college, I sold whole life insurance and disability insurance. I had my financial planning degree. It was like going to the dentist for me. I mean, it's important stuff to have in your portfolio, but I just wasn't excited about it. And I failed at sales and marketing. Okay. And the point I want to make with your listeners is for 20 years in the high-tech world, I avoided those roles. Whether I had talent in that or not, I had such a bad experience. I had a mental block. But when I actually fell in love with what I was doing and I realized I was just educating, teaching people about a fascinating topic that they knew nothing about. So many people I talked to, I couldn't believe you could invest in a 300-unit apartment or a self-storage unit mobile. How do you do that? So I became an educator. So I think the best advice I can give to people is I had no clue I would be good at this. People would say, for what I do and how far I've come, it's like, wow, that's incredible. But it's because I surrounded myself with good people. I took on kind of this education mindset and sharing thought leadership, which is what you're doing. We're out there, we're providing information. People come to my website, great. We take them from there and educate them and show them some ideas. But the business evolves over time because of trust and relationships. And like I said, 85% is recurring. So it's a wonderful business. It's a wonderful way to get into the business. And I've been very blessed and very excited about the partners I have, very great partners. And I guess if I've done anything right, I've selected good partners.
Yeah. That's definitely. Yeah. It's tapping into that, tapping into someone else's business system or system that's already been, it's already successful. They've got all the different pieces, especially the ones that you don't bring, put together, and it's already running, and you're just kind of adding more value to their group, and it helps everybody. And it's a win-win for obviously everybody that's on the general partner side and all the limited partner, all the passive investors as well. Anybody involved with the deal.
Absolutely. And I think one thing I took away too is almost everybody needs capital. It doesn't matter how successful they are. They want to do bigger deals, more deals, and so that's a skill set that maybe you can explore. You certainly have to do other roles on the team and be prepared to do that because from a legal perspective, we have to be doing more than just that. Yeah. But I look at this whole thing as it's great because I have to know all that to answer investor questions anyway.
Right. But it's also funny about speaking to people that aren't aware of the whole syndication model because you'll speak to someone and they say, oh, I bought like a 6 unit somewhere and it's like in a D class area and they're not living there. They're like, oh yes, one of my golf buddies told me about this, or, hey, I bought a duplex, and well, that's great for learning, but you're not going to be able to scale that business, especially with having a 40, 50, 60 hour a week.
Yeah. I mean, anything 4 units or under, we started going that direction. My wife and I did, and quickly realized it sounds like you can get a little more cash flow per door, but it's still, I needed my W-2. I still needed to deal with all the administrative stuff around that. And at 2015, I stopped buying single family homes in Austin, Texas, realizing I was cash flowing better in passive investments. I'm like, I can do better, and I'm not having to manage any of that stuff. And then it dawned on me, like, if Dave Thompson's not buying single family homes, and Austin's been a great market, and he stopped, well, then maybe, and he's doing the syndication, well, what's he doing with his own money? I'm like, I'm not buying any more single family homes. I'm not doing any more active stuff. I'm holding them because I think in the long term, it's a great market here, and it's manageable. My wife's managing them now. She's more patient. But I think that says something. So what are the experts doing? Follow the experts. Are they investing in their own deals? Are they doing what with their money that they're telling you that they think is a good, wise strategy for you?
Yeah. No, that's awesome. So, well, great, David. So how can people learn more about yourself and Thompson Investing?
Yeah, so you can go to my website, thompsoninvesting.com. It's all one word, THOMPSON investing.com. I have a lot of articles there. We've got some podcast stuff going on there. We've got 2 books you can download for free. One's on raising capital, and one's called Riches and Niches, which if you're an investor, I think it's awesome. It's a book that kind of gives you a high-level view of the 3 niches that Charles and I talked about today and why we like them. And then my email is david@thompsoninvesting.com.
Okay, that sounds great. And I'll put all those links in the bottom of the email, and you can, or in the bottom of the notes. And right on the website, you can pull down and they can download all those books by.
They can do that, and they can set up a call with me. I've got a way to just collect some information from you, and then we can set up a 30-minute call and learn a little bit about you and what you're trying to do. See if we can share some ideas. Okay, that sounds great. Well, thank you very much for being on the show. And Charles, thanks for having me. Yep, have a great rest of your day. I appreciate it. Thanks a lot. Take care. Hi, guys. This is Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in investing in real estate and you don't know where to begin, set up a free 15-minute strategy call with me at schedulecharles.com. That's schedulecharles.com.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Harborside Partners Incorporated exclusively.